Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week, my guest is Ali Nazar. Ali, you want to start off by just introducing yourself to everyone?
Sure. First of all, thank you so much for having me. It's a pleasure to be with you. People ask me where I'm from and what do you do, and those are the fundamental questions that I have a hard time really answering anymore. Because I feel like when they ask me that question, of course my ancestry is Indian, but and I'd like to mention that because I'm eighth generation in commercial real estate investing.
Wow.
Going back to India. To the bartering days and whatnot. And so I'm really proud of that heritage. I've grown up all my life in the U.S., really, except for we moved here when I was almost 5 from London, from England. Yep. And so I've been in the States since kindergarten, and in California since 1977. And proud to say I'm second generation in the mobile home park business. And the politically correct term, as we call it, manufactured housing communities. And so, yes, we've been in that business since 1981. And so, yeah, since 81, I've seen, I don't know, at least 9 downturns in the market, recessions and bubbles and bursts and all kinds of things, and found this asset class to be incredibly resilient. And so that's where we live. This is our domain.
No, that's awesome. And yeah, I have heard the same thing about it being very resilient because honestly, it's affordable housing, and whenever there's something affordable, whether it's things are booming or things are in a tougher spot, people need a place to live that they can afford.
Absolutely.
Okay, so you got a second generation, which I did not realize before doing this. So I guess your story into going this is just following your parents or your father or your mother into the business, and maybe also when you're answering the question, if you just want to say what kind of, are you brokering these deals? Are you buying these? Are you syndicating them? What does this deal look like? And maybe I'm asking 2 questions at the same time, but what does the deals look like and how did you get into this?
Sure. So I was 12 years old when we bought our first park. And I think it's important for your audience here, they could probably relate to this. We were actually in the single family home business prior to that as investors and flippers and doing all kinds of things. My father had about 120 homes in Orange County, California. I think those would be worth probably on the average of a couple $1 million each now, on their own. But that those houses were really built like a house of cards. They were highly leveraged at the time. My father was highly leveraged, and when the original Iran war happened, like we're going through now in the late 70s, where inflation was crazy and mortgage rates went to 20% or so. As crazy as that sounds, as you may know and recall, in the States. Crazy. So those 120 homes came crashing down like a house of cards, stacked up and it was just overnight that happened because people couldn't pay us rent, people couldn't buy homes from us, they couldn't, we couldn't sell anything. It was just a freeze. And so my father salvaged what he could from that. And it's a little side note here is that when we moved from New York to California, Glen, we actually took a 3-month summer journey in an RV, in a trailer across the country and stayed at KOA campgrounds. And so that's where he kind of got an insight into the business. The market crashed in 80, 81, where the single family home business just crashed. And I think he was able to salvage enough equity, enough liquidity to put a down payment on a park, the first park. And so like I said, I was 12, 13 years old, and you can imagine a typical immigrant family or whatnot. I mean, you run the business together. So I wasn't in football and all the other things, but I was KOA Joe. The first park was a campground. It was a KOA, and so and we quickly learned in that business that Glenn, that business is seasonal. You have the fluctuation of overnighters and transient revenue and hospitality and all that. So you have it's seasonal, the seasonality aspect we didn't care much for. So even in that first park, we started putting in trailers that we purchased, and we expanded. We put in trailers. We essentially leased them out long term.
Yeah.
So long before tiny homes and ADUs and all these small spaces became a thing, before hybrid work and all, we were doing that in the early '80s, and for for construction crews, for local factory workers, for seniors who were individual, single and retired, for anybody who needed a small space, and it worked out really super well. And that's where we discovered, okay, we really need to transition into the mobile home park and manufactured housing community space. And I can give your audience maybe a little bit later a dozen reasons why, beyond what we've talked about, where it's an essential. It's an essential, and it's the most affordable essential, right? That's why we're in that space. Unlike the RV park business, it's not really a going concern. It's not a Main Street business that has a retail component to it. It's more of a passive, or at least semi-passive, recurring income stream and steady income stream. So maybe even sometimes lower cap rates, or lower metrics, excuse me, lower cash on cash, lower ROI. But the trade-off is it's also far less management intensive. And so to answer your latter part of your question, we got into as we bought that first one, and we basically we essentially just started expanding through 1031 exchange, through rolling on. And so it was private funds, a lot of debt, not over leveraged like the homes, but primarily through debt versus equity players. And so we grew the portfolio. Ultimately, over the decades, have developed a family office that's now on autopilot and kind of stabilized. And the family will decide, the family collectively will decide what we do with that portfolio. However, I know at 56 with 3 teenagers that I'm not done. I'm really, I enjoy the space. I enjoy working with others. And so I've created a fund where essentially now the structure, to answer your question, is that under the fund, we acquire more properties. I'm bringing in investors and equity that way to go and acquire more communities and scale. So transferring that knowledge of 45 years and bringing it to people who don't have the time to go back and do that and reinvent the wheel.
So what do these parks look like that you're buying now? Is there, check boxes of like stuff that's a no-go, or that's a yes go when you're looking at these?
Yeah, so my preference, and I'll look at anything and everything, because I'm like you. I mean,
Yeah.
I'm not gonna be limited to a certain buy box, but I shy away from that term, and then I somehow end up back with it oftentimes. But I think the general ideally, I'm looking for at least 100 units. I'm looking for 2 to 3 star communities. One being the least appealing, let's say, with curb appeal and whatnot, and probably the highest cash flow, by the way, but the least appealing otherwise. And 5-star being the most stabilized and having the curb appeal. I like to be in the middle, the 2 to 3 star, and the range in terms of asset value, I would say 5 to 25 million, and oftentimes even more specifically, maybe even a little bit lower, like 3 to 15 million. The point is to be above Main Street buyers and below the REITs and institutions, private equity groups, and kind of carve out my niche there. And I would say for your audience, if anybody's getting into it, that at least 50 units for someone who's kind of relatively new is still sufficient for someone. But below that, you don't really have the economies of scale.
Gotcha. And so based on those kind of purchase prices, I'm guessing you're buying the type of properties where there's actual homes on it, because I know there's a couple different strategies I've heard of with mobile home investing, where you're or manufactured home investing, where they're just selling the pad and people are putting their own homes on the pad. Are you looking to invest in the US? Are you looking for a coaching program that will actually save you money and help you avoid mistakes? My students get discounts on lawyers, attorneys. If you're looking to get an E2 visa, if you're looking for certain software, if you're looking to even speak with CPAs, I have discounts for all these things. If you want to just get on a quick phone call and we can discuss if it's a fit for you, 10-minute phone call, go to glensutherland.com or at CanadianInvestingInTheUSA.com and book a call.
That is the conventional model, and that's what lenders love. That's what appraisers love. That's what the whole industry loves, is to keep everything arm's length. And I agree with that too, by the way, as a former mobile home park appraiser. The idea is to keep, by the way, and this is, I think, helpful for the audience to understand that the reason for that is the income from real property should be kept separate from income from personal property. And those homes are considered personal property, much like your car, because they don't own the homeowner doesn't own the land underneath it. You do.
Yeah.
So essentially, in most cases, it should depreciate. There are exceptions, like California, where I am, where even those homes appreciate for different reasons. But but essentially, you should keep those income streams and values separated. And so that said, so our community, a real property ownership is under one entity, but part of our strategy is infill, what we call infill in this industry, and that means to buy a distressed, or at least if not distressed, let's say a half full, maybe 50 or 60% occupied community,
Yeah.
and they're not vacant because those pads are not vacant, Glenn, as you know, due to a lack of demand for affordable housing. They're vacant only because of the upfront costs, the barriers that prevent a resident who wants to live in that space, who can't afford that lot rent, but just can't afford all the upfront costs and doesn't really know how to handle transportation, installation, some of the other things that need to get done that financing in a home doesn't include. And so, yeah, so that's the barrier that we solve. And we do it by owning, we have a dealer arm. It's a separate entity, arm's length, where we purchase the homes wholesale and we'll place them in our own communities. And then where it's permitted, and I would caution everybody to get their own legal advice and whatnot, but where it's permitted, we also have a financing arm. So we provide relatively, easier financing to those buyers, because at the end of the day, the goal is to increase our income in the asset and increase our asset value. And so if we can solve this challenge that the residents have who want to live in that community by providing these services, it's like an inverted funnel going up towards the community. And so I wouldn't be in the business of flipping homes, frankly, a mobile home, just for the sake of it. I wouldn't be in the financing but I'm in those businesses for the purpose of our primary business of increasing our income and increasing our asset value at the community.
Yeah, and also it helps your own community by having those different parts to the whole thing. Like you said, if the tenants can't figure out the financing or find out the home or figure that part out, and you're also from my experience of interviewing other people about like manufactured housing, it's you're making it so you don't own all these homes, you don't have all this maintenance, that's all on them, so you're pushing that off. You're making the appraisers happier because it's easier to just appraise basically a balance sheet, and you're looking at like the septic system or SEP or whatever, or city water or whatever, and all the things that are hooked up, but you're basically taking a lot of this stuff off, and you're just cutting grass or removing snow, but probably not snow for California, depending on California. I guess some in Northern California might have some snow.
Sure.
But no, I like this. I like this idea, and I like the idea of handling all the different sort of aspects around it, because then you can control the process and control how it's going through. So anyway, my next question: if you were to buy something like with a home, like you said, you're open to all different options when you're buying a property. So if you're going to buy a manufactured community and all the homes on there are currently owned by the owner of the home, the manufactured home community, do you start like basically a lease option program or sell them the properties? What does that look like? Or do you just take over the way that they are currently doing it?
So for the most part, thank you for asking. For the most part, I would absolutely transition from park ownership to tenant-owned tenant-owned homes. And that would be, in some markets you can do kind of a lease to own or rent to own model, but I think it would be, in my case, more ideally a structure of where we actually do provide seller financing, as much as possible, and truly get away from any kind of ownership in that home as quickly as possible. Yeah, it's just, to your point earlier, I mean, what better scenario where you have all the upside of real estate? You have the cash flow, the tax benefits, the opportunity to trade via 1031, trade it up. You have all the upside of real estate, but not most of them. You have hardly any of the typical landlord headaches, with our model. And so that's what we want to stick with. And it's a process. I am not opposed to. Some people won't even buy. To really dive in a little bit more to your question, many investors I think would shy away from buying a community that has largely park-owned homes. And I'll do it if the if everything else checks out, and even there, I think it's fine. But here's a nugget for the audience. I think what you have to be super careful of when you buy a community like that is most of the time those brokers or sellers may include the income from those homes into their cap rates and into their metrics, and that's a pitfall that a lot of newbies kind of fall into, because you're appraising it wrong, you're valuing it incorrectly if you do that. You cannot, right? You can't value the income from personal property the way you do from real property. So those need to be separated. I'm not saying there's no value. There's some value, but that needs to be carved out and appraised or valued separately. And you have to really look at what the land value is based on the income from that land.
Oh yeah, and you're going to have to look at what the future look of this whole park is going to be, because what you're buying isn't what you're turning it into, right? So it has to still make sense.
Correct.
If you have a financing company for these homes, when you buy a park that has park-owned homes on it, you said seller financing? Do they finance it to the park home, or do they finance it through the financing company? If you're a Canadian interested in U.S. real estate, there's a 60-second quiz that will tell you the safest strategy based on your specific situation. Because here's the thing, there isn't one way to invest in the U.S. as a Canadian. The right move depends on your budget, your risk tolerance, and what you actually want to get out of this. Most Canadians I talk to are stuck in the same spot. They know the U.S. opportunity is real, they've done some research, but they're sitting on cash because they don't want to guess their way through setting up corporate structures, cross-border taxes, and picking the wrong market for the first deal. The mistake isn't lack of information. It's that generic U.S. investing advice doesn't account for your situation as a Canadian. It doesn't account for your capital, your timeline, and your appetite to be hands-off or hands-on. So we built a 60-second quiz that gives you a personalized answer. Which U.S. investment strategy fits you right, whether you're actually ready to buy or what to fix first, and the smartest next step based on where you're at. It's free, it takes about a minute, and you'll get a customized game plan at the end. And it's not a generic PDF. Go to CanadianInvestingInTheUSA.com/quiz. It's also linked in the show notes. Take the quiz, get your game plan, stop guessing. You don't need to figure this out alone. You just need to know what your next move is.
Through the financing company. I said seller financing loosely as just right. But yeah, it would be in California, you'd be required to have a CFL license, a consumer finance lender's license.
Yeah.
And so it would be under that arm, and I like for anybody that's thinking about that strategy, I like to actually keep everything separate. So when they're making that house payment, for example, they don't do it at the office at the community. These things are completely separate.
Different companies, different everything. They're talking to a different person, so it's not getting muddied.
Correct.
When someone's going to like a tenant is going to go and finance the purchase of a property, or how long do they finance this over? Because I know the home prices are a lot lower. I assume they're not doing 30-year loans.
No, typically they'll be 15, 20, maybe 25-year loans, but I think to your point, they're amortized over that duration. But they're typically due within 5 to 7 years. Okay. So, even my loans, they'll be due in 5 to 7 years. That's enough time for someone to be able to refinance that loan, once it's been seasoned, and maybe even get a better rate and whatnot. So, yeah.
So if they're going to refinance that, is it kind of like going to the bank and getting a car loan or a line of credit, or can they get finance it like a conventional or an FHA, or what do they even do? Because they don't own the land, so it might be more complicated for financing.
Well, yeah, now it was very complicated before. I think we came up with financing because initially, and I might add, financing was impossible, not just for the homes, but there wasn't really conventional financing even for the property, for mobile home parks, Yeah. It's only been the last 10, 15 years, Glenn, that institutional money, agency loans, all these kinds of larger players have come in and where there's actually even financing available for the communities and for the homes. So, but now there are a good, I don't know, half a dozen lenders who specialize in mobile homes across the country, national ones, and then there's a whole bunch of other ones in regional lenders. The credit unions also do it. So financing is available now.
Okay. And so like it just a little different to wrap my head around. So compared to like a house, if someone didn't make their payments on a manufactured home, I guess it depends on the situation, but do they like just take the home out of the park, or do they evict the tenant or the owner, I guess, in those situations, or do a foreclosure? What does that look like if they don't fulfill their terms?
Yes, it's a rare occasion because most people aren't going to give up. And let's say just I know in other markets the numbers may be much smaller, but no,
Yeah.
just for example's sake, who no one's going to give up. Most people don't want to give up $100,000 mobile home and their primary shelter
Yeah.
to default on $1,000 lot rent,
Yeah.
or a $500 home payment, right? And so we don't really have a high default rate, but it happens. And the process to answer your question is, as you suspected, you essentially put a lien on the home. So as a community owner, I really have, the record is 3 to 5% bad debt where you see those defaults. But in terms of the net, in terms of my collection is 100% because I can place a lien on the home. And sure, theoretically, someone could pull the home out, but that's typically cost prohibitive. I mean, you're talking
Uh,
about, right?
yeah,
Yeah,
five,
you
10 grand probably to pull it out. So yeah.
per section.
Yeah.
And sometimes in our markets even higher. So in California it could be, $10,000 to $15,000 per section. So a double wide could cost you $30,000 to move. And if it's worth 100,000, you're not gonna spend 30,000 to do that, even if it's worth more. And so typically the home never leaves. It'll get renovated, and so even when we have communities where we have largely retirees, seniors, and we see, unfortunately, of course, circle of life, people pass, they move on, the home doesn't.
Yeah. Just talking about the liens and underwriting, like if you're going to find a lien on a house, it's fairly easy to do. Um, is it even of a concern to you buying a mobile home park or a manufactured home park, to be checking for liens on properties because it's not really as long as they're paying the lot rent, that it doesn't really affect you, or is it something that you need to do in your underwriting?
It's typically not something that's done in the initial underwriting.
Okay.
You bring up a fair point. I mean, it's not a bad idea to kind of have
An
an
idea, I would say.
idea.
Yeah.
Yeah, but it's typically not, a driving factor in the deal. Only because as long as, let me say this, fundamentally what you're renting out is dirt, right? And you're renting
Yeah.
out those lots. And as long as you can justify the demand is there for those lot rents, and then at that rate, I think that's the core issue that most investors are looking at.
Yeah, it's really interesting. It's almost like running an HOA over like, doing real estate. You still have to maintain all of the, amenities and the things in there, but not actually have to deal with the homes. Um,
Correct.
so when you buy one of these properties and say there is homes that are owned by the park, then if someone stops paying, like, is the eviction similar? Is it the same eviction laws as if it was a house, or is it different in these sort of situations?
It's very similar. It's essentially the same, but there's two separate processes, one for the lot rent and one for the home, right? So the home is much easier. That process is much like if you were to, default on a car,
Yeah.
and whatnot. And so, but on the lot rent in California particularly, they have the tenants have all the typical protections, just like you would in an apartment or a home and anywhere else.
Okay. All right. That's so then it also would play in if you were going to keep the homes in that's, where they weren't going to be owners, where they're going to keep tenants, then you might be still wanting to look at, landlord friendly states versus the tenant friendly states if you are going to keep those, which I know isn't your model. It's very interesting.
It's still an important issue. Most people won't invest in California or a lot of the, blue states because of what you just brought up. I mean, rent control ordinances, vacancy control issues, eviction process, the time, the cost, everything. And so, when you mention, California is not for everybody, and I just use California as an example, but probably the behemoth, right? Maybe California, New York, the most difficult. But that said, in some ways, I turn that into a positive for us in that, while most Californians don't want to invest here anymore, they're investing out of state, and most out of state folks don't want to invest in California. For someone like me that's been around for 45 years and with a Rolodex, that just leaves more opportunities
Oh
where
yeah.
I really, yeah, that I understand, the market here.
So you just were talking about different locations. Is there a specific location that you like to buy? Do you buy all different states, or I know we've talked a lot about California. Is it mainly California where you're looking?
Currently, we're only in California. But that said, I've done business out of state, and I would again, like we talked about in the beginning of the conference. I don't want to rule out any good deal where it makes sense. But also, I like maybe like you too, Glenn. I know you probably fly down to the states a lot, but you could probably drive down to some of your investments, in Huntsville or whatever. And I like the idea of just being able to. Sure. If I don't mind flying to Houston, right? But
Right.
if I'm going to take, but if I could travel 4 hours to my park and my investment to Houston, or I could fly there, or I could drive 4 hours to Bakersfield,
Yeah.
or a market. I'd rather drive. I'd rather have the option to at least be able to drive, just in the event of it. We've seen some crazy things in recent years, right? Like the pandemic and whatnot,
Yeah.
and so it just makes me feel better. And of course, the other aspect is. So the proximity is great. The low hanging fruit is great. If I run out of low hanging fruit, I'll go out of pocket, out of the state. But the other aspect I love about here is the absolute dollar size, right? So while in percentages things may look great in the Southeast or the Midwest or whatever, in absolute dollars, if I'm not getting a great, if I'm not seeing a sizable return to justify my time. I'd rather just, boil the eggs here where the return, I can boil more eggs essentially at the same time.
Yeah, there's probably you talk about economies of scale for just buying 100-unit buildings. There could be property management or other companies that you've already worked with in the same area. You might be able to, use the same, you're not, if you were buying your park homes from a certain spot, you're not having to transport them across the entire country. It's going to be like a 4-hour drive, like you're just talking about, to get them there maximum. So it's gonna make sense just from being in the same location, and you become a bigger deal in one spot. I interviewed somebody when I first started investing in the US, and I was telling them like, oh yeah, I just bought some stuff in Huntsville, and then I bought some stuff in Indy, and I bought some stuff in Missouri. And he's just like, you need to be a big player somewhere and not just scatter your stuff everywhere, or you're going to be no one to everybody. And I'm like, you know what? It's true. You get like better property management rates, you get better everything. I know you're doing a lot of stuff yourself, but just doing that makes a lot of sense, and I can see it.
Sure.
Yeah. I had one more question I wrote down on my sheet. Just
Okay.
it popped in my head when you were talking, and it was regarding the ability to change the lot rent. Do you have to like justify that? Is there rules around it? Like if they're paying a certain amount basically for the pad and their utilities, or is the utilities all included, or is that a separate what do you call that?
Separately
Invoice
metered?
besides that?
Yeah.
Yeah. How does
Yeah.
that kind of look?
Yeah, so let's start with the latter first.
Yeah.
The utilities. There are many communities that have private water and sewer, so septic tanks and
Yeah.
water wells and whatnot. We shy away from those anymore. There's just, you really don't know what you're getting underneath, and it can become a real nightmare at times.
Yeah.
Not to say I won't do them, but that's not the preference. And so if they have city or municipality services, great, and those are direct billed,
Takes
and
it off your plate. Yeah.
exactly. But if they are where you have to submeter and you can get a pass-through income, some people like that. I'd rather just not have that income and not have that headache.
Okay.
But and so and then on the rent, in California, it's well known for rent control, right? So, and in some cities, we even have this vacancy decontrol, vacancy control, vacancy decontrol issues, and so it can get complicated with the rent. You can even, and I would argue, and I wrote an article about this not too long ago, with a contrarian view, that even in markets where isn't rent control, that as community owners, as in real estate investors, we should be mindful and we should be very strategic about how we scale rent increases to avoid backlash, to avoid, challenges, and to do what's right all around for not just residents, but for us ourselves, for investors, thinking long term, not just the short term gains, right? And so I don't like I'm concerned about bad actors who charge larger amounts or have substantial increases in short times that make it difficult for the rest of us who are trying to be reasonable. But let me give you some specifics to your question. Like, for example, here in California, we typically can see a couple of points above CPI. So if CPI is around 3, we might get another couple of points above that. So it wouldn't be unreasonable to see 5 to 6% even, or even 4.5 to 6, let's say, a year, annual increases around that range, which I think is still is reasonable. I mean, it's not as great as maybe it used to be, where we used to see like 10%, and it certainly isn't 20%, 15, 20% where I see some people doing those kind of things, in certain markets, which I disagree with. I just think you're setting yourself up for, for a lot of backlash and trouble.
Oh yeah, yes, yeah. If you're just thinking from the tenant's perspective or the owner's perspective, I guess the people who live in the actual homes, that if you want to have predictable, what you're paying every year, and if it's jumps substantially, it affects your livelihood and everything else, right? So it's it makes a lot of sense to like keep it at a predictable sort of numbers.
Right.
Before I let you go, is there anything that I should have asked you about mobile home parks that I just maybe don't know, or maybe the listeners would really need to know?
Well, no, I mean, this has been really enjoyable. I think, look, when people ask me why, first of all, I think the first answer is, and I'm very biased towards my space. So forgive me if I offend anybody, but we even asked ChatGPT and I think other AI LLMs, like, please compare all the CRE asset classes and look at all the things, whether you're talking about tenant retention or or operating expenses or ROIs. I mean, you name it. We did, and anybody can get this report from me, and we can talk about that later. But we did a survey, and we came up with our own scoring board system. Our team did, my team, and we came and. Mobile home parks outshine every other asset class by far in all of these metrics, whether you're talking about the things I just mentioned, with tenant retention, operating expenses, ROIs, returns all over, just, and then let me, because I get passionate, Glenn, but let me bring up a few examples of like, for example, just to be able to have be able to hedge my risk and my bet, so to speak, over 50 residents or 50 tenants versus the same, maybe only having 5 tenants in industrial, or maybe even in single family. My down payment, if I'm investing in real estate, if my down payment buys me 5 single family homes versus 50 lots in a community, I'm going with the 50 lots, right? Because my risk is spread over many more people.
Yep.
So I can make the mortgage payment. I can at least cover the debt service or expenses, right? And when we talked earlier about the opportunity to buy and sell homes, I won't call it a monopoly, but it's almost, I think you alluded to it earlier, like you have a farm, you have a relationship, you have essentially intelligence, you have almost a first right of refusal to buy a home from somebody who's leaving, or to place a home in a vacant lot. It's really that kind of almost monopoly like structure is very compelling to me. We already talked about the fact that it's an essential and really the most affordable essential if you want to have the American dream. Yeah. I think the only thing we didn't talk about today, which maybe we can talk about some other time, that is indirectly related to this asset class, but to all of us in any asset class within CRE is what's happening at the macroeconomic level, the geopolitics, politics that impact our business as CRE investors. And it's not even about, it's not a political conversation. It's just math and arithmetic. And I'd love to have that conversation sometime if you'd like, about how, those things impact the bond rate, for example, the bond yield, and how that just as an example impacts our availability of funds by banks, small banks, regional banks, to CRE investors, or the lack of. And then what happens? Yeah, and what happens when you see a major crisis like we've seen before? And I think when the herd gets sidelined and you have all this opportunity, how do you do deals then? And so anyway, I could keep going.
No, we'll have to set up another one, schedule one out in another 6 months or something. Spread it out a little bit, but we'll do another one on that sort of stuff because that sounds really interesting too.
Sure.
Ali, before I let you go, people are like, "Hey, I like what he's doing. This sounds interesting." How do they find your company? How do they work with you? What does that look like?
Sure. You can join us either as JV partners. You can join us as passive investors. You can join us in just for education or consulting, or you could just call us and say, "Hey, I'm going to do this all on my own. I just want to chat and get some advice." So we have a whole team here at Rise 360 Ventures. The best way to reach us is rise360ventures.com. You can also find me on LinkedIn, and we just recently started a YouTube channel where a lot of my podcasts, like including this one, hopefully ultimately will be there after you give us permission.
Awesome. I will. I'll send it over.
Okay.
Ali, thank you so much for coming on the show. I really appreciate your time, and you can even tell from my questions, I'm always looking to learn more.
Absolutely. And thank you very much, Glenn. I've watched, like I said, several of your videos, and I learned from them, and I look forward to speaking with you again.
Oh, thank you.
That was a nice video. Bye.